What is tax loss harvesting?
So tax loss harvesting was a strategy which we used for many of our clients actually when the markets fell, and this was in March when the markets were falling quite a bit. And what we try and do, as the name suggests, we try and harvest the losses that clients have made in their portfolio to reduce the overall tax liability in a financial year.
What are the checks to be done when doing tax loss harvesting?
Right, so the checks that need to be done are you first need to obviously understand the rules of the offset and carry forward, which we will talk about later. The first is the exit loads. So typically you need to check the client's portfolio to ensure when you are doing these changes to reduce the tax liability that the client is not hurt with exit loads. Second is to ensure that you follow the rule when it comes to tax loss harvesting, which is basically on a FIFO basis, that is first in, first out. Only the units that have been accumulated in the first set of investments, say it's a systematic investment, only if those units are in loss can you offset those losses against the capital gains. So the check needs to be done that the losses were in the first part, and then only you can offset the losses. The third and an important check is to see that short-term capital losses can be offset against short-term capital gains or long-term capital gains. However, long-term capital losses can only be offset against long-term capital gains.
Can you offset short-term capital loss against short-term capital gains?
Yes, you can offset short-term capital loss against short-term capital gains, provided it's within the same asset, short-term versus short-term.
What about inter-asset set-off?
Yes, you can offset a short-term capital loss in equity against a short-term capital loss in debt. Again, provided the first rule is maintained that it is short-term versus short-term.
Okay. If there is a loss and you have not set it off, what can be done to reduce tax liability?
So if there is a client who has not booked any capital gains, say in the last financial 24-25, there is a provision to carry forward the losses for up to 8 financial years. So what we do is we could even use it in financial 25-26 that we are in currently, or we can carry it forward depending on our other tax optimization strategies that we would do for our clients in this financial year. I wanted to explain this with an illustration. So here we had a client who had almost 25.69 lakhs of capital gains, both short-term and long-term, in financial 24-25. And the tax was coming to almost 3,06,000, both short-term and long-term tax, using the rules of before 31st March and after, etc. Not getting into that. So what we did is we identified in the client's portfolio, ever since the market fell, which was October 24 till early this year, we tried to use the losses that he's accumulated, which we took into consideration the short-term losses, which added up to almost 17.2 lakhs, and we reduced that from the total gain of 25.36 lakhs, and therefore we were able to reduce his tax to 97,000 versus the 3,06,000 that was earlier the case.